The Middle East crisis is entering its sixth day, and hopes for a quick resolution are fading. As market assessments shift toward a multi-month conflict, a transition being called the 100-day shift, we've reached a critical line in the sand for the S&P 500. According to Nana, this repricing of geopolitical risk is the defining factor to watch before Friday's close. Optimism is fading as the conflict hits day 6. With Brent crude stabilizing near $84, global sovereign debt is undergoing a sharp repricing. This energy shock stems from a 20% supply hit at the Strait of Hormuz, forcing traders to scale back. Fed cut expectations for the year have now dropped to 45 basis points, down from 60 last week. The energy shock is driving a sharp divergence across the market. Brent crude has stabilized near $84, fueling outperformance in the energy sector, even as supply risks mount. Nana reports that disruptions in the Strait of Hormuz currently threaten about 20% of global oil supply. We're seeing the impact hit airlines like Delta immediately, as rising fuel costs put heavy pressure on the tape for high-consumption industries. With the S&P 500 near 6880, MacroVoices suggests a specific hedging framework to manage this volatility. As swaps traders dial back easing expectations to 45 basis points, the channel proposes an April 16th caller, buying a 65.35 put and selling a 7100 call. This structure is designed to protect against a break below 6800. The channel identifies this as a critical floor where systematic selling could accelerate. MacroVoices identifies 6800 as the critical line in the sand. They warn that breaking below this level could trigger systematic selling loops as institutional safety mandates kick in. At the same time, the US dollar is staying strong. This is described as a mechanical result of global flows being forced into dollar-denominated treasuries as a safe haven during geopolitical stress. To navigate the current volatility, MacroVoices suggests a specific hedging structure, an April 16th caller. This setup involves buying a 65.35 put for downside protection and selling a 7100 call. At the same time, the US dollar is staying remarkably strong. This isn't just about market sentiment, it's a mechanical shift. Institutional safety mandates often force capital into dollar-denominated treasuries whenever global risks begin to escalate. Looking beyond the immediate geopolitical volatility, Jeff Curry recently joined MacroVoices to outline a thesis on a structural rotation in market leadership. He argues that the equity-heavy bull market of the early 2020s is giving way to a commodity supercycle that could define the rest of the decade. In this environment, metals and strategic materials are expected to outperform hydrocarbons as electrification and sanctions continue to tighten global balances. This rotation is being driven by a synchronized global fiscal push expected in 2026, which Curry describes as a major demand shock for real assets. At the same time, the channel notes that commodity hoarding and de-dollarization are broadening as central banks seek reliable alternatives to traditional reserves. Jeff Curry argues we're in the middle of a structural rotation. The equity-led bull market of the early 20s is handing over to a commodity supercycle that's likely to define the rest of the decade. As shown here, metals and strategic materials are expected to outperform hydrocarbons, driven by the shift toward electrification and the impact of global sanctions. Curry believes a synchronized fiscal push in 26 will provide the necessary demand shock to cement this transition into real assets. This shift is being driven by what MacroVoices calls the 2026 demand shock. It's a three-way pressure point: a synchronized global fiscal push, central banks aggressively hoarding commodities, and an accelerating move toward de-dollarization as institutions hunt for alternative reserves. On the energy front, MacroVoices reports that Allo Atomics has set a target of July 4, 2026, to bring its first prototype modular nuclear reactor online. This project is part of a broader industry push to resolve the power bottlenecks that are beginning to constrain AI data center expansion. On the watch list for defensive positioning, Linde stands out. A $10 billion project backlog underpins their projected 10 to 12% earnings growth, even if industrial volumes remain flat. We're also tracking Mercado Libre for momentum. Adding 6 million fintech users last quarter shows they're scaling effectively through macro headwinds and outperforming competitors like Nubank. The observation watch list for the next few days highlights 3 critical areas. First is Broadcom, to see if its earnings strength can provide a floor for the broader tech sector. Second, Linda serves as a gauge for defensive positioning in manufacturing. Finally, in the energy complex, Goldman Sachs estimates that a $14 geopolitical premium is already baked into prices. The week's final catalyst arrives Friday with the non-farm payroll report. 42 Macro notes that while the Federal Reserve is still in a restrictive stance, they argue policy needs to shift toward neutral quickly to prevent a jobless recovery.